All right, IUL premium financing. So this, what I have done is that I actually got a illustration of premium financing, and we'll do the case study on this. Okay. So this particular case that I designed was age 50, male, prefer non-tobacco or non-smoker. Death benefit is a 1 million. Death benefit option is increasing. So it increases, cash value increases. And another thing that I forgot to write down is that more than 99.9% of the time, it's 100%. Almost all premium financing requires you to have enhanced cash value rider. Or in National Life's case is a balance sheet benefit rider. What that rider will do is it eliminates surrender charges. As it is eliminating surrender charges, from year one, your cash value is a surrender value and your surrender value is a cash value. They're all same. What's the catch? Number one, the agent gets commission over 6 years, not all in first year, which is good and bad depending on the situation. For client, there is a fee during the surrender time. So the client will see little bit of a reduction on their cash value. The cash value growth will be a little bit less with the balance sheet benefit rider. But you have access to all your cash value because there's no surrender charges. Okay. So what is a Kaizen? This is a small premium financing. I told you last week there are two different types of premium financing. Premium financing, key word on the premium financing is a leverage. What are you leveraging? Your premium. How do you leverage your premium? Leverage means that you got 10, but you're using 20 of force. That's leverage, right? So what you're doing is that you leverage your money by getting a loan from the lender on your premium. That's what we call it, premium financing. So in this particular case, the client pays half of a premium for first 5 years, and he lends another half from the lender. And from year 6 through 10, he's not paying any money, but the lender, the bank, is paying 100% of money. So that's what we call leveraging the premium. Why do you want to leverage your premium? There are two reasons why people want to leverage their premium. Number one, they want to leverage the premium so that they'll have bigger cash value. More money you put in, more cash value you're going to have. So you're going to have a faster and bigger cash accumulation. Another reason for premium financing will be you want to have a bigger death benefit. If you put more money, that means your death benefit is a lot higher. Okay, it goes on both sides. But if your emphasis is on leveraging your death benefit, more than likely we're dealing with a big premium financing deal. A lot of times you're instead of 25%, you're putting only 10% and you get leverage of 90% of premium. That means you're gonna have to have a loan application. That means you're gonna have a collaterals on your loan. You need to make sure you qualify for the loan. So a little more trickier and a little more detail. But we're talking about big premium. One time I went to Premium Pacific Life training many years ago, and the presenter said that the average premium financing case premium per year was $250,000. How do you like to sell life insurance with $250,000 annual premium? I mean, you'll be happy selling this. If you sell two of those every year, you'll be rich, right? This particular one that we're dealing with, we are focused more on the smaller amount, and we're focusing on the cash accumulation. So key is that he is only putting half of his premium for first 5 years, and he's not putting any more premium for the next 5 years, and the remainder, about 75% of total premium, is paid by the lender. So you're leveraging that 75% of the money. So you're actually putting 4 times, 3 times more than what you have put in. So if you look at this particular case, year 1 through 5, the client is putting 38,450, and year 6 through 10, he's paying no money, and the lender is paying first 5 year 34,859. Year 6 through 10, he's putting up 71,959. So total premium that client has put into this policy is $192,000 and 250 for first 10 years. The bank has put in $534,000 and $534,090. So total contribution is $726,000. Don't you want to get a commission on that? Okay.
Mm-hmm.
All right. Another thing that you have to remember is since it is a bank who's lending more money, he's putting up more money for your own life policy. So this policy will be insurance trust owned. You're not going to own it. The trust will own it, okay, until you pay off the loan. So the trust fee is about $1,350 per year for 5 years. So $1,350 times 5, and it covers 15 years of trust maintenance. The why 15 years? This product is designed so that you put money 5 years, you get more money lended next 5 years, you wait 5 years, on 15th year, you pay off the loan. From where? From the cash value. So what's the collateral? How does bank or lender guarantee of the receipt of money? They put a lien on the cash value. Okay? So there's no lien. You don't have to pay anything more than your premium plus $1,350 for first 5 years, and everything's all clear. Okay? So this example will show you. So loan interest, I mean, you have to think about loan interest. Since bank is a lending premium, how much is a loan? This is the last 15 years, 3.75, 4.68, 4.46, 4.31, 4.24, 4.2, 4.19, 4.18, and so on and so forth. It's somewhere in 4. What is our average rate of return on index universal life? Anywhere between 6-7. So you get about 2 to 3% spread. That goes to your cash value. Okay, you're using somebody else's money, and you are pocketing 2 to 3% of that difference. We call that spread into your cash value. So your cash value grows bigger and bigger and bigger and bigger, right? So cash accumulation at projected cash accumulation at 15th year will be $1,066,279,000. Meanwhile, bank has put up pay for your policy $34,859 for first 5 years, and $71,959 for next 5 years, plus the interest. You're not even paying back the interest during that time. So interest is going back to the original principal. So that blow up to be $772,000. So this amount will be paid off by cash value on 15th year. So now at this point, you own the policy clear. So now instead of it being insurance owned, the trust owned life insurance is owned by you now. You have ownership all over. Now, at the time, the death benefit is about $570,000. Your projected annual income is $52,000 until age 90. How much tax do you pay on that $52,000?
Nothing.
0. Tax free. Right? So you got tax free money, but you see, for client's point of view, he's putting $38,450 for 5 years, and starting at age 65 to next 25 years, he's collecting $52,000 income tax free. Meanwhile, he has the death benefit right here. Let's say on fifth year he die. We don't want him to die, but on fifth year he die. If he die, his family will receive how much money? The death benefit at that time will be 1.163 million. Now, but he has to pay back the loan. The loan and interest at that point is $199,000. So he pay back 190. I guess he's no longer here. His family will pay back $199,000 and will receive almost $1 million income tax free death benefit. How's that? It leverages not only, his intention was leveraging cash value, but it leverages his death benefit too. Now, here's another thing to think about. On fifth year, instead of him dying, he has a stroke. What do? We have something called living benefit. If he has a stroke, he can make a arrangement with the insurance company so he get part of it or all of his death benefit, right? For his condition. So he can get instead of waiting until he died to collect death benefit, he can make a loan against death benefit to get the money. At that time, what do you have to do? Whatever the living benefit payout, you need to make sure you pay off the loan to the lender. Can you do that?
Mm-hmm.
Yeah, you got 1 million and then loan is only 200,000. And here's another thing. What if you, instead of individual use, you want to use it for a key person? You have a business and one of the key employees profiting company so well, and you wanted to make sure that you're covered just in case he die. Can we use this as a key person? Yes,
Mm-hmm.
you can. As a company, you only pay $38,450 for 5 years and done. And if anything happens to the key employee, you get $1 million or more of death benefit in the company. Now, that's not the end of it. Let's say this was employee and he's retiring at 65. You can give him this policy back to him. He's getting $52,000 income tax free money. This is how you make sure that that profitable employee stays with you. In order for him to have this kind of deal going, he needs to stay with the company for what? 15 years. You got golden handcuff on that key employee. Here's something else. Do you get a tax deduction on the $38,450 going in for key employee?
Yeah. Oh, no.
No, you cannot. You will not have a tax deduction on key employee, unlike a lot of people think. It is still treated as a business expense, but this is not tax deductible business expense. But what about the interest? The money that is going in is not tax deductible, but what about interest? Is there room to make an argument that this was a business loan and the loan interest is tax deductible? Yes, there's a room for an argument. That's why some of the people use this for key employee benefit also. Okay? And there are people who are saying that, hey, why do we even need to put someone else's money? Why can't I just buy policy myself? So one scenario is you put $38,450 for first 5 years and no more money. And that's because the Kaizen requires the client to put $38,450 for 5 years. And the thing is, if you just do that, you get, instead of $1 million policy, you get $500,000 policy. Excuse me. And with the calculation, you get about $29,000 income from age 65 to age 90. Whereas a Kaizen, you got same amount of money going in, but because you leverage your money, your income is $52,000. If you're using the same money, do you want to get a $29,000 income or 52,000 income? That's not even a question, right? Um, is 52,000 guarantee? Is $29,000 guarantee? No, it is not. It is index UL, so interest rate fluctuates. Now, 1980 is the nearest worst time for what? Stock market. During that decade, we seen stock market crash 2 times. Okay, Bianca wasn't here, so she wouldn't know. But that's what happened. 1980 is the worst time for stock market. If this was done during that time, your annual income is instead of 52,000, it would have been 39,000. Is that bad? Not bad. The worst stock market time is in 1957, the stock market crash and Great Depression and all that. During that time, if it was done during that time, $34,000. Not bad. I mean, more than likely, we're expecting $52,000. Even the worst time in the history, we're looking $34,000 annual income. Is there reason? Is there enough reason to do premium financing? Yeah, it's something to think about. It's not for everyone, but it is something that you can think about doing. Okay. Is there a loan application? There's no loan application. What happens if a bank is payback? If bank is payback, it's as though nothing has happened. You own the policy, clear and free, and the bank has no say whatsoever. Okay, the fee 5 years. Yeah, there's reason for the fees. Are there additional features of your trust? I mean, here's another thing that you have to think about. Your cash value is not protected from the creditors, not as much as you wanted to think if you own it. But what if it is an insurance owned? You only put 25% of premium. Who owned the policy? Not you. Your trustee, but it is an insurance trust. But if you get sued or if you file bankruptcy, is that cash value safer? Being insurance trust owned versus you personally own it? You see the difference? There's additional protection. Okay. How will I know how my policy is performing? I mean, you got annual statements, right? Policy changes and things, you caps and participation, you guys already had training on that. So 5-year commitments and you get this money coming. And you're leveraging your death benefit and the cash value. Once again, why premium financing? This is a slide from last week. Potential for more accumulation, maintain current lifestyle because you get more money to your pocket, more protection for you and your family, diversify your asset. And the qualification is about at least 100,000 a year income, and that has to be shown on your income return, tax return. And you're between age 18 and 65. You're in good or average health, and you can contribute about 22,000 a year for about next 5 years. I mean, if you can do more, that's okay. Can you use something else other than premium financing loans? I mean, if you have a personal loan, I think so. One thing that you have to look at is the spread between loan interest versus projected cash value rate of return. Okay?